So ladies and gents, it's now 2:30, so it's a perfect time to start this afternoon's talk. And this afternoon's webinar is entitled A Guide to Inheritance Tax, and it's been hosted by My Money Matters. Let me introduce myself so you know who's speaking today. So my name's Greg March, and I'm a senior financial education coach for My Money Matters. And I've got the pleasure of taking you for the next half an hour or so exploring the benefits of understanding inheritance tax. But just before we do that, let me give you some important information, as you'd expect. So first and foremost, the content from today's webinar has been designed purely for educational purposes only. So please don't take anything that I say today as regulated financial advice. And I would recommend that if you do have issues with inheritance tax, you do seek the appropriate regulated financial advice. And these slides have been put together based upon our current understanding of taxation and treatment and legislations, and this could change in the future. And also, just so you're aware, the webinar may be recorded today for training and compliance purposes. Now, for any content when it comes to inheritance tax, one of the best places you can look if you do need further support is to go to the government's website, so gov.uk/inheritance tax. Now, during today's talk, if you have any questions, then please feel free to ask those questions. And the format for asking those questions today is by using the Q&A box that you can see on the top right-hand side of your screen. So if you have a question, just drop it into the Q&A box, and then what I will do is I'll attempt to answer that question for you at the end of the chat. What I would say, though, please, no personal questions in the Q&A box. Just keep it to a very generic basis if you can. Now, before we get into the content on inheritance tax, I just want to introduce you to what My Money Matters actually is. Excuse me, because you may have seen us before as AVC-Wise. So as of Monday this week, My Money Matters was a name change from AVC-Wise, because currently, or what we were doing previously, was giving you education purely upon retirement. And what we'd like to do now is give you education, and free education at that, on different areas. So outside of retirement, we want to give you education on the following themes. So debt and money management, savings and investments, estate planning, which is where you are today. We've also got education on insurances and protection. And then, as you'd expect, we continue with the education on retirement. And the way in which we're doing that is we're offering you webinars, and later on we will also be giving you blog content as well. And all of that information that we will look at will cover the following. So we'll look at things like mortgages. So you might well be looking at getting onto the mortgage ladder, or you have family members who want to get onto the mortgage ladder. We'll give you the education around that. Understand the credit scores, could be debt planning, debt handling. How do we set up financial goals? Taxation and understanding how tax works when it comes to savings and investments. And then under the estate planning threshold, we've got, as you'd expect, inheritance tax, but we've also got other webinars that we run under estate planning for wills and will writing, long-term care, and also funeral plans, which is not a very happy webinar to present, but it's out there, and the lasting power of attorney. And then we've got information, as you'd expect, under insurances and everything you've ever seen before when it comes to retirement and the share cost AVC. So this is the reason for the change from AVC-Wise to My Money Matters, is so that we can broaden the education that we can offer to you. So what I would say is make the most of the platform. Come back to the platform as often as you can, and join these webinars on a regular basis. And what we do find as well is that with some of the content, inheritance tax especially, can get quite confusing, and we only have a limited time to present these. What a lot of people will start doing is coming back to the same webinar 2 or 3 times, just so that it starts to sink in with the content and the material. So feel free to come back to these webinars as often as you can. What I would also say as well is spread the word. So if there's something that you've seen and you like, tell your colleagues so they can benefit from the education as well. So what are we going to look at then today? Well, the first thing is we're going to ask that question, what is inheritance tax? Now, I know most of us will know what inheritance tax is, but let's just kind of give you the definition as described by the government. I'm going to talk to you about strategies with inheritance tax, so what we can do to maybe reduce the liability. I'm going to talk about this thing called a 7-year rule that you all need to be aware of, and then we'll show you we can get further support going forward. So all of this I'll run through in the next 25-30 minutes. If you do have any questions, and please remember to put them in that Q&A box, but keep them generic if you can. So let's ask the first question then, what is inheritance tax? And I think before we actually answer that question, I just want to give you a quick phrase by Scarlett O'Hara of Gone in the Wind. And she said this: death, taxes and childbirth, there is never a convenient time for any of them. And I think we're spot on with this one, because inheritance tax is a very, very nasty taxes payable in the event of death. Now, some states were happy paying it, but if you think of it logically, it's paid upon death, and it's not really a great tax to have. But let me give you a breakdown of what an inheritance tax is, probably in its simplest form. So inheritance tax, or IHT as it's referred to, is a tax that's levied on the estate of a deceased person. Now, an estate, because a lot of people get confused with this, includes all the assets, the property, the possessions that was owned at the time of death, plus potentially any gift that was made within the last 7 years. So if I was to die today, it's every single asset that I've owned and potentially gifted in the last 7 years. So it's a big tax. So when we're talking about inheritance tax, and we quoted the phrase there, assets, let's kind of give you a breakdown of what we mean by assets. So in the event of death, all the following will be calculated. So it's your main home, your main residence, less any mortgage. It could be properties you've got elsewhere, so worldwide properties, any cash that you've got around the house or in the bank, any investments you've got that aren't in trust, possessions, so these are your chattels, there are some exemptions, life insurances that you may have that aren't in trust, and then what they do, they calculate the total value for you, and then we have certain allowances. So the first allowance we've got is what we call the residence nil rate band, and you're allowed to have 175,000 as a value of a property that's exempt. And then we've also got something called a nil rate band, which is the value of your estate outside of your property, which is exempt, and that's 325,000. So this is how we calculate the tax. So I'm going to give you an example of how all of these work. And any tax that's liable, the government will request that you pay tax at a rate of 40%. So if you've got a liability to an inheritance tax, then you pay tax at 40%. So let's assume we've got a property. So I'll give you an example of 300,000, and I'll bring it down these assets. So we've got no other properties. We've got cash in the bank of 100,000. We've got £50,000 worth of investments, and we've got £60,000 worth of possessions, just as an example, life cover that's not in trust. So when we get to the stage where we look at the total value, so under this example, 535,000, the first thing we're going to do is potentially, and I'm going to say potentially, because I'll come back to this in just a moment, is we take away the residence nil rate band. So that's the value that you're allowed to have in your property up to 175,000. And then from that, the balance, we then take away what we call the nil rate band, which is the amount the rest of your assets can be worth in your estate before there's any tax liability, and that's a further 325,000. So this simply means that if we've got an estate worth more than that, anything that's in surplus of that amount, we then pay tax at 40%. So under this example, we've got a balance of 35,000 that's due. That 35,000, the government will request taxes paid, and they normally request it before the estate's actually released, of £14,000. So you can see how quickly the estate values can build up, and anything over, under this example, 500,000, then we pay tax at £14,000. Now, that tax that you pay of 40%, that level of inheritance tax that we pay, you can actually reduce that to 36%. And the way in which you can reduce that is if in your will you have gifts to a charity or a political party, then they will reduce the tax liability to just 36%. So if you want to make a gift to a charity or a political party, then you're able to. And as long as that's 10% of your net estate, then the inheritance tax rate will be 36% and not the 40% that's charged to the majority of people. So when we're looking at the nil rate band on the residency, so this is your main home. So in the event of death, remember you've got that 175,000. You can use that, but only if you're passing your main home to children. Now, with any form of taxation, you also have to understand that when they say children, there is a specific list that goes with that. So this is the list that relates to children. So a child could be your biological child. It could be an adopted child. It could be a foster child. It could be a stepchild, or it could be a grandchild. So they form the definition of children when it comes to using the nil rate band for any transfer of your property. Now that list is actually quite what's the word I'm looking for? It's quite a long list, because most taxes, there are a very short list associated. So this is quite a generous list, if that makes sense. So your residence nil rate band, so the ability to have 175,000 in a property before we have to pay tax, is only allowed if you're going to pass it to a child, as you can see up on the screen. Now, you also have to take into account as well that when we're talking about inheritance tax, there are other rules that we need to be aware of. And one of those is if you're widowed and your partner, the deceased partner, hasn't passed anything on as a gifting, then you can have their threshold as well. So any unused inheritance tax threshold will be passed over to a surviving partner. And the unused residence nil rate band is also passed over to the surviving partner. So you've got two allowances. In the event of death of one partner, the two allowances can be passed over to the surviving partner. So when working out what the threshold is going to be, if we assume there's been no previous gifts, and we'll come back to that in just a moment, made by the deceased partner, then the allowance would be as follows. So let's just keep it simple. Let's say I was married to all of you today and I died and I've not made any gifts. You've got my 325,000 threshold for inheritance tax, plus the 325,000 threshold for yourself today. And we'll come back to that in just a moment. So that means that your estate can be worth 650,000 before there's a liability. Now, in addition to that, remember you've got your residence nil rate band on property as well. And also you've got mine. So again, I die, you've got 175,000 that you can have in your estate, plus my 175,000 on the property that hasn't been used. And that's a further 350,000. So when we add the two together, what this simply means is if you're in a relationship, one person dies and you're going to be passing part of your property on to your children, then your estate can be worth £1 million before there's an inheritance tax liability. Now, again, that's a massive amount of money that your estate can be worth. And this was, I think, remember David Cameron, he said that when he leaves politics, he's going to ensure that the threshold for inheritance tax was £1 million. And that's potentially what he's done. So this sounds like it's a massive estate. But again, remember, if you're living further down south or you've done well for yourself, look at the property prices, look at what you own, and it soon creeps up. So it sounds a lot, but it soon creeps up. So what I'm going to do is give you a quick example of an inheritance liability, and we'll have an example where a gift has been made, so you can see how this works. So this is Mary, and unfortunately Mary passes away this year. Now, last year she gifted, and this is in addition to her exemptions, and we're going to come to exemptions in just a moment. She gifted from her estate £162,500, and she was very generous, and she gave that to her sister. Now, this equates to 50% of that £325,000 nil rate band. So this is 50% of the nil rate band. Now, Mary was married, and Mary's husband was known as Bob. And let's assume that Bob dies in 2030. When we hand over the nil rate band, what you've got to take into account is that the nil rate band, so the 325, is actually handed over as a percentage. And that percentage is then linked to the nil rate band on second death. So let's assume when Bob dies in 2030, that the nil rate band has increased from 325,000 for the estate value to 500,000. So that nil rate band's increased substantially since Mary died and left part of her nil rate band to her husband. What happens is this: when Bob dies, his estate will benefit from the nil rate band in the year that he dies. So under this example, £500,000. But remember, he's also carrying 50% of Mary's nil rate band as well. Now, remember when Mary died, the nil rate band was 325,000. But this 50% though is linked to the nil rate band when Bob dies. And it's important that you kind of take that on board. So in the event of somebody dying, you'll get their percentage of the nil rate band that hasn't been used. But in the event of your death, that nil rate band will actually link to the nil rate band in the year that you die. Now, remember, I said this is confusing, and I know it's confusing. You can come back to these webinars as often as you like, just to pick up on things you haven't picked up on before. And that later on, we will be putting these recordings out as well. So under this example, remember the nil rate band when it's passed over is a percentage, but it's actually related to the nil rate band in the year of the second death. So Mary, she got 50% of Mary's nil rate band based upon the nil rate band at Bob's time of death. So this means he's got 500,000 nil rate band in his own right, plus a further 50% of that, which is another 250, which means that his estate can be worth 750 before there's any liability. Plus, they've also got the residence nil rate band as well, as long as they're leaving the house to the children. And the residence nil rate band is based upon the date in which Mary died. So let's assume there's no changes to keep things simple. There's another £350,000 there. That means under this example, Mary and Bob can have an estate worth 1,100,000, even though Mary died years ago and made substantial gifts. Hopefully that bit's helped, but we can always come back to this later on if you need to. So let's have a look at an example where other gifts are made. So if the estate is worth more than £2 million, so this is where we're looking at the real big estates, then that residence nil rate band, so the ability to pass part of your property tax-free to your children, will start to reduce. And it reduces for £1 for every £2 over an estate worth 2 million. So if you're sitting in the audience today and you've got an estate worth 2.35 million, congratulations. But this means, unfortunately, you don't have a residence nil rate band to pass on. So just take that into account as well. So what I would say, if you're in a situation where you do have an inheritance liability, realistically, you need to be seeking regulated financial advice. That can massively reduce your liability. Now, talking about reducing your liability, there are certain things that you can do when it comes to inheritance tax. Before you go, if you want me to phrase it that way, and one of the things you could do is look at gifting. So with inheritance tax, this is a way in which you can actually reduce the liability. And there are different types of gifts that could be made. And the government look at gifts as follows. They say one gift could be exempt. So they've labelled it an exempt gift. And I'm going to cover those in just a moment. But then another gift could be something called a potentially exempt gift, which means it may be liable to tax, but it may not. Gets confusing, but hopefully this will become clearer in just a moment. And then the third gift that you need to be aware of when it comes to inheritance tax is what we call a chargeable gift. So what I'm going to do is take you through exempt gifting, potentially exempt gifting, and then chargeable gifts. So let's kind of explain how this works. So when we're looking at exempt gifting, what you need to be aware of is that we all have certain gifts that we can make where we know there'll be no tax liability, irrespective of when death occurs and the value of your estate. Now, the first thing you need to be aware of is if you are in a relationship, husband and wife, any gift transfer between the both is totally exempt. So again, if I was married to you, if my estate was, let's say, I don't know, for the sake of maths, £1 million, and I gave all of that to you, there is no tax liability, and vice versa. Also, what you've got to understand as well is that if you wish to make gifts, as we've already touched upon, you can make gifts to charities and political parties from your estate, and they could be deemed as exempt as well. And remember, if you make sufficient that you're making 10% of the net value of your estate, then this could reduce the tax liability of 40% down to 36%. So husband and wife exempt, and if you want to make gifts to political parties and charities, that'll be taken off your estate as well. Outside of that, this is what we can do. So we have a series of gifts that we can make, and the first one is our allowance of £3,000. This is our annual exemption when it comes to inheritance tax. So each year you have the right to gift to one person or to a number of people £3,000. And when I say a number of people, 3,000 is the maximum. So if you're going to give it to two people, then that's, if you love them the same, £1,500 each. You can't give everyone 3,000. So you've got the allowance of 3,000 that you can give to one person, or you can give it to a combination of people as long as those gifts don't exceed 3,000. And irrespective of when death occurs, that gift will never be brought back into your estate for tax purposes. Now, if you haven't made a gift this year, and you're thinking, well, or last year, sorry, you're thinking, well, I'd like to make a gift today, you can carry back 1 year. So if I haven't gifted at all, I can do my 3,000 for this year plus 3,000 for last year as well. So in fact, I can give £6,000 to somebody or a group of people today, and then that will not form part of my estate in the event of my death. So that's quite an important allowance for you all to be aware of. Outside of this, what we have is what we call the small gifts allowance. And this is where you can literally go out and give £250 to any number of individuals that you think is fit. So you could, in theory, stand at the end of your road, bag full of envelopes, £250 in each envelope, and hand it out to every single passerby that goes by. So that's the small gifts allowance. Outside of this, the government then says on birthdays and Christmases, you can gift, as long as it really comes from your, you can gift, and also from regular income. So when you're gifting on birthdays and when you're gifting at Christmases, the government says that'll be exempt. And if you're gifting something that comes from your regular income, so your pension or your salary, and what they mean by that gift is that you're making a gift without having to go to capital to replace it. So if I was to give, let's say, for argument's sake, £5,000 from my regular income, and I don't touch my savings, that will be an exempt gift. But if I gave £5,000, let's say, from my regular income, but then popped down to the local bank and took £5,000 from the bank to replace that gift I've just made, that will be potentially taxable. So it's got to come from regular income. And then the only other gift we got that are exempt are gifts on marriage. So if you've got a child of yours that's getting married, then you're allowed to give them £5,000. If it's a grandchild, you can give them £2,500. And for anyone else, you can give £1,000 on marriage. So these are what we call exempt gifts. So it's a £3,000 allowance that you can carry forward. So that potentially could be £6,000. You've then got the £250. You've got birthdays, Christmases, and regular income, as long as you're not replacing that. And then you've got gifts on marriage as well. They're exempt. So you make that gift, you don't need to worry about it. Just keep a record and don't worry about it. But one thing you've got to be aware of, though, when we're talking about gifts, is this thing called a gift with reservation. Because, believe it or not, some people will try to gift something just to avoid tax, but retain the benefits. And that could well be, let's say, your main home, or it could well be a car. If you're making a gift, let's go back to the main home scenario, and let's say you gift that to your children today. And you say to the children, right, I've given the house, but the only reason for doing that is so I can avoid inheritance tax. But we're going to live in a house, and we're going to live in the house, and we're going to be rent free. In the event of death, what the government will do is that they'll go back to that gift and state that mum and dad lived in the house, so it's a reservation because the children couldn't sell the house. And they'll also ask the question, did mum and dad pay the rent on the property? And it's not like a pound rent, it's got to be the full market value rent. And if the answer is no, then we'll take that asset back and they'll put it in the estate for tax purposes. And even if they were paying rent, one of the other questions would be the child or the person that received it, were they declaring that on their income and were they paying the relevant tax? So when you're making a gift, remember, it's got to be a full gift. You can't give something and say, pick me up every single week in the car. You can't sell it until we pass on. It's got to be, here's the car, here's the house, you can sell it tomorrow, and that gift will then be allowed. But remember, you've got that reservation. So anything that the government thinks is not right, they will potentially contest. So any gift of reservation, if it's proven to be a gift of reservation, will form part of your estate going forward. Now, the other rule that you need to be aware of with inheritance tax is that there is this rule called the 7-year rule. And this is where the gift could be potentially exempt. So what we mean by that is you could make a gift today and potentially that gift could be taxable. So let me explain how it works. So when you're making a gift, what you should be doing is making a note, and that note needs to be with your will. So in the event of your death, if these questions are asked, the executor of your will can answer the questions correctly. What the government says is this, is if you make a gift today and you die within the next 3 years, then you've gifted, but unfortunately not quick enough. So under this ruling, the government will request 100% of the tax that was due. So that 40% tax, whatever it was, they're going to request 100% of that tax. So even though a gift has been made, you've died too quickly, and they will correct the full rate of tax. But this is where planning can actually come into it. So if you then make a gift and think, well, I'll make the gift today, I don't know when I'm going to die, but let's just say we die between year 3 and 4. then the government will request 32% as a tax rate. So instead of 40%, they can request 32%. You reduce your tax burden by living 3 or 4 years. But if you can get your strategy right, and then you gift and survive a little bit longer, then for every year that you survive, the rate of inheritance tax that your estate's going to pay is going to reduce. And then when we get to 6 or 7 years, we pay 8% as a tax rate. But if we're lucky enough to survive 7 years plus, then there is no inheritance tax to pay on that gift. So one of the plans that you could put in place today is just be aware that it's possible to gift, and as long as you survive 7 years, will fall outside of your estate, and therefore there could be no tax to pay. But remember, that's an outright gift, not a gift with reservation with things like property. So this is known as the 7-year rule, and this is where the people you speak to, so if you speak to your solicitor or you speak to your financial advisor, we'll talk about potentially exempt gifting. So make a gift, live 7 years, you're all right. Make a gift and die before the 7 years, there will be tax, but it'll be less than if you didn't make the gift. So it's called the 7-year rule. And then there is a possibility as well, just to confuse matters, that if you are making gifts and you die, there is a possibility that the person that received the gift could actually be left with an inheritance liability. So let me explain this one. So what I wanted to do, I want to introduce you to this chap. His name is Ishana. He's a wealthy businessman and he's made lots of gifts in his lifetime. Now, the inheritance tax at the date of Ishana's death was £325,000. So these are the gifts that he's made. So 12 years ago, before his death, he made a gift of £50,000 to his brother. And being a very wealthy businessman, 4 years ago, he gifted £325,000 to his sister. And then just under 4 years ago, he made a gift of £100,000 to one of his friends, John. So Sean has been very, very generous in his gifting. But what does this mean for taxation? So let's look at the first gift that was made 12 years ago. So under this gift, where he gave £50,000 to his brother, this gift will not be taxable. And the reason it's not taxable, well, it's more than 7 years from his date of death. So he's gifted, he survived more than 7 years. So that, if you picture that gift as a conveyor belt, that gift has dropped off the conveyor belt because he survived more than 7 years. So his brother's got no tax to pay. When he gifted £325,000, what we then do is we look back 7 years. And as that gift was the £325,000, there's no gift in the previous 7 years. That £325,000 is within the threshold. So that's going to be free of inheritance tax as well. So this leaves then a gift to John. Now, John was gifted 3 years and 6 months ago. So what we have to do with John is that when we look at this gift, we go back 7 years. And unfortunately, £325,000 was gifted to Ishana's sister. So that means that the threshold within that 7-year period has been utilised already by Ishana's sister. So this means that the £100,000 gift that was made to John has a tax liability. And what this simply means is this, is that for John, there is a possibility, well, there isn't a possibility, there is a fact that he will need to pay HMRC inheritance tax on a gift that he received 3.5 years ago at a rate of 32%. And the reason it's 32% is that 7-year window, so the tax reduces. So this means that he has to pay tax to the government of £32,000. So I know it doesn't happen all the time, but if you ever receive a gift from someone, somehow you need to find out what their gifting habits have been, because it could be possible if death occurs within 7 years of the date of that gift, and if the threshold's been previously utilised, that you could have a tax liability. And technically, under this scenario, John is responsible for paying that tax. So when you're looking at the gifting, what I would say to you is, if you are in a situation of gifting yourself, or you've been in a situation where you receive gifts, the executor, so this is the person that's going to deal with the estate in the event of death, they need to know those gifts. So they need to know what gift was made and to who. So if you've received a gift, make a note of it, of what you've got, and also ask the person that made the gift to you. So if, let's say, your parents are gifting you, they need to keep a note as well if their estate is in excess of the 325 and the 175 when it comes to property. They also need, as an executor, to know what the value of the gift was. So again, it's all about record keeping and the date in which the gift was made. Now, the potentially exempt tax will be paid by the estate. So if there's a gift where the survival occurs within that 7-year period, or death occurs within that 7-year period, then that's paid for by the estate. You've got to keep records, okay? But going back to that other scenario, if the gift with John was made within the last 7 years and it exceeded the nil rate band, then the recipient is liable to pay tax. Confusing, I know, but come back to this webinar more often. And the more you come back, the more you'll understand. There's a lot of information to give you in half an hour, but the more you come back, the more you'll understand. So it isn't black and white when it comes to gifting with inheritance tax. There is a possibility where outside of those exemptions, there could be a liability that may need to be paid by the estate or by the person receiving the gift. So when we're talking about planning, there's lots of things that we can do, and we don't cover everything in this webinar. There's just not enough time. But one of the ways in which you can plan is consider those gifting strategies. Consider your £3,000 on an annual basis, that $250, the gifts from income. Use your exemptions. That's what they're designed for. Also, look at wills as well. A will is a very good tool when it comes to planning for inheritance tax. And if you haven't been so already, come back to the My Money Matters webinars. Go back into the estate. If you've done your financial health check questions, then they should become apparent for you. But go back into the estate planning section and come on to a will writing webinar. So it talks about how the wills can be used as well. So it's a really good planning tool for you. And if you're in a situation, and again, seek the right financial advice on this one, and probably legal advice as well, is you can put money into a trust. Now, we will be bringing out a trust webinar later on. We don't have one quite ready yet, but we will bring one out later on. And that basically talks about what happens if you do put money in trust and how that can be used to avoid inheritance tax. And guess what, ladies and gents, pensions. So this thing that we always think about as, you know, the thing that we have to pay in so we can retire. If you're of wealth and you don't need access to all the funds you've got, it is possible that money's left in a pension can be a tax efficient way of handing money over to your estate. So pensions aren't used when it comes to inheritance tax to calculate the value of your estate. Think about your AVCs and things like that. It's a really useful thing that's available for you. But the key to all of this, though, is inheritance tax is a tax that never comes at the right time. It is a tax upon death. Some see it as a nasty tax. So you need to seek the right professional advice. Because if you do seek the correct professional advice, then it's possible that you could reduce your burden, your tax burden, the burden to your family. And remember, if you're gifting, especially with property, make sure there's no reservations. So the next steps for all of you is think about what you'd like to do. Remember, under My Money Matters, we do have a host of webinar themes, and those webinar themes will continue to grow. So everything from retirement through to inheritance, through to savings, debt planning, it's all there for you. Make the most of it. But if we haven't got content that you want, then contact us. And the way we can do that is if you contact us at suggestions@mymoneymatters.co.uk. So that's suggestions at my-money-matters.co.uk. If you send me an email, then what I'll do, if I'm able to, I'll create the content for you. So even if we haven't got it on the platform we've got, remember, it's brand new, it's only just started on Monday, the platform will grow and grow and grow. So even if you've been to a couple of webinars and you don't see anything else, come back, because there could be more content there. Well, there will be more content there for you later on. Excuse me. And if you want to contact us for any reason, then feel free to contact our customer services. So ladies and gents, that's it for today. That's your inheritance tax webinar. So it's not the happiest of all taxes to think about, but it's a tax that we can actively avoid with planning. But it does take planning to avoid it properly. So what I'm going to do is just jump to a different section to see if we've had any questions come through, and there's no questions. So let me kind of bring this webinar to a close. So inheritance tax is avoidable. It's an expensive tax. The government is trying to increase the thresholds. They haven't done it for a while, but they are trying to increase the thresholds. There is this discussion about will inheritance tax ever be abolished. Personally, I'm not too sure, because it brings in so much to the state, but it's something that we can abolish with planning. but all you need to do is seek the right advice. So ladies and gents, thank you very much for your time and attention today. Hopefully you found today's webinar of use. And remember, get back on the platform and then visit other webinars that we've got. It's there, it's for you. Make the most of it. Thanks ever so much and enjoy the rest of your day. Take care. Bye.